Right, let's look at the numbers. Asian markets setting a positive tone for global stocks this morning. The Nikkei in Japan up about 0.5%. On the mainland in China, the composite index up about 0.25%. Generally, it's been a very good month for world stocks, with investors hoping that interest rates can start coming down while inflation tempers as well, the so-called Goldilocks scenario. However, a gauge of manufacturing in China sank for a second month in November. The official Purchasing Managers Index, which looks at sentiment among factory managers and really the health of factories, fell to 49.3 in November. Anything below 50 indicates contraction in the sector. Oil prices fell in Asian trade after the weaker than expected activity in China. Well, over in the United States, stocks actually ended lower yesterday as a robust upward GDP revision eased recession fears, while Fed Reserve officials' remarks raised questions about the duration of the central bank's restrictive policy ahead of inflation data. The Dow Jones Industrial Average up slightly, the S&P down a fraction, however, and the Nasdaq Composite dropping 0.16%. We are looking to a higher opening on Wall Street today, though. European markets are currently trading higher, but no great shakes. The FTSE in London in the last hour or so up slightly. The DAX in Germany up by 0.5%. The CAC in Paris up slightly as well. The JSE All-Share Index up about 0.5%. Let's look there, up 0.6% at the moment. The Rand trading at 18.80 Rand to the dollar or so. 23.83 Rand to the pound sterling and 20.56 to the euro. Gold is trading at $2,041, platinum at $927 per ounce. The price of Brent crude oil above $83, 83.60 per barrel. All right, let's look at the ups and downs. We're joined by Viv Govender, Senior Analyst at Rand Swiss. Good afternoon, Viv. Thank you for being with us. Can we start with the less than exciting news, the poor data coming out of China? What does it mean for the Chinese economy, looking at that manufacturing data, given the concerns around China at the moment?
Yes, the Chinese economy it looks very vulnerable right now. We've had a number of issues, especially in the property sector, that seems to be, perforating throughout the rest of the economy. They're facing issues with regards to, a number of different sectors in that economy. To give you an idea, the property sector in China is about a third of the GDP. It seems to be in a kind of a slump that's probably worse than what we saw in the property sector in the US in 2008. And back then, property in the US was a smaller percentage of total GDP. So yeah, it is a significant, problem in China. And it's going to be a problem in South Africa as well, in places like Brazil, Australia, because China, due to the way its economy is structured, it really purchases commodities at a rate that's well above what its GDP would indicate.
So it's a problem for our miners already facing a whole lot of woes, like trying to export their goods. Some are saying that China could stagnate unless policymakers take more drastic action. What is needed?
Well, here's the thing, right? It's leadership probably that's required. China is rich, but China is only very rich as a country because the population is so high. China's gotten to a point right now, which is called the middle income trap. A lot of countries have gotten to this level. Look at Brazil, you can argue South Africa is here. A number of countries have got to the point where they're like South Africa, they're richer than the poor countries, but not rich as the rich countries. And taking that step from being a country like South Africa to a country like, for instance, Greece, or say Singapore, or say Japan or Taiwan, a country that went from being poor to being rich, is a step that very few countries have made. Most of South America has not made it. Plenty of countries in Africa have gotten to a point where they are wealthier, but they haven't gotten to over that gap. And China right now is facing that middle income, trap kind of problem. They've gotten to a point where they're definitely richer than they were a little while back, but they are not at a point where you can compare the average Chinese income to any first world country. Forget about the US. We're talking like a Greece or Portugal or those kind of countries. China is nowhere near as wealthy per person as those countries. And getting to that next level requires, more of a services economy, more of an economy relying on things like, IT and so on. Unfortunately, with the Chinese government being the way it is around, controlling information flow and controlling the economy, they do well when it's the manufacturing economy, when they have big companies that they can control, like Alibaba and so on, or like big manufacturers they can control. But when it's a more, small business, more, diversified, decentralized kind of economy, it's not as easy for a centralized power like the government to control it, and it probably requires an act of will for the government to get to the next point.
Yeah, very interesting. So the government has to let go in a sense. All right, let's look at the good news, well, the overall picture. And there's a lot of positive sentiment. The festive Santa rally, it's been called. Investors are hoping for the scenario where inflation can temper, but central banks can still bring down interest rates. What do you think? Is that a fairy tale?
Look, I mean, it seems historically to be a fairy tale. I mean, I don't think it's happened in the past where we've gotten to the kind of inflation rates that we've gotten to right now, and they've gotten back to be on target without getting into a recession. We've seen historically that it always results in a recession. But, the first time is always going to happen for something, so you might not, be happening here. And we saw recent US GDP numbers, for instance. They upgraded the GDP number from 4.9 to 5.2% for the last quarter. The US is doing at 5.2%. To give you an idea, that's roughly the size of Russia in the last year. The US has added the economy of Russia to itself in the last year. So, we would argue that, there should be some kind of inflation happening, or should be some kind of recession happening as you try and fight inflation with such high interest rates. But right now, it does not seem to be occurring. We see inflation come down dramatically. Most parts of the world coming down, except for South Africa, unfortunately. And we see growth rates that are reasonably high, and especially in the US, extremely high.
So I think there was an economist said that the world economy is defying gravity at the moment. So are those recession risks, are you saying they're still there? What's happening now seems to be confounding many people.
Yeah, look, I mean, there's one thing that you need to understand when it comes to economics is there's often a lag because the economies are big. It's very hard for an action to have immediate effects in the economy. So one of the things that we know in economics, you learn it like first or second year, something called the monetary policy lag, which is the time from which you raise interest rates to the time it impacts the economy. And according to some estimates, this period can be 9 months up to like 30 months. From between like less than a year to almost 2 years. Now, if you put the average, which people are talking about, it's like a year and a half or so, there, you'd say that much of the effects of interest rate hikes would be only coming into play next year, which would mean that you would be seeing, that negative effect on the growth and maybe the possible recession happening next year. Just because, yes, we raised interest rates and we haven't seen that come through. And we see that coming through with U.S. housing sales recently, which came to a multi-year low. Until very recently, it was amazing that despite interest rates rising, housing prices were not falling in the U.S., which makes no sense because you raise interest rates like they've risen in the U.S., and you'd often find more than a 50% increase in the amount you're paying for a bond. But yet that wasn't happening, and the fact that we're seeing a reflection happening in the housing market now could indicate that we are coming to that period where the lag is catching up with the interest rate hike that happened maybe a little while back.
All right, so something could be coming next year. I mean, how do you think the markets will sort of square out the year before that?
Well, the market is quite forward-looking, like you said, and there is that historical thing which is called the Santa Claus rally, which tends to happen at the end of the year. And so I think without any news, without any kind of negative impact out there, the market probably, is looking reasonably positive. And there's what's also called window dressing, which is, sometimes, people get bonuses and stuff based on how well their funds have performed. And so sometimes they do little kind of actions where they put a lot of losses into one quarter, and the last quarter wasn't that great, and then put big profits to the next quarter, and then suddenly you see, you beat your targets for that quarter and you get a big bonus. You don't get you don't get negative bonuses, don't take your money away from you, but you get big bonuses when you act positively. And so there's some window dressing happening there as well, probably. And so I think that comes together to indicate that we're probably going to have a reasonably positive, at least, end of the year. We've already had an incredibly strong November, double digits in like the US and so on. So I think we are looking at a reasonably positive end of the year. That being said, next year is going to be very interesting. We have a lot of issues happening. Just recently, I don't know if you noticed that, but there was apparently an uptick in uncertainty in South America, of all places, where the Brazilian army suddenly became more active because of a possible invasion of Guyana by Venezuela. And so these kind of effects, strangely this year, are also going to be a problem going into the future, like Russia was a couple of years ago.
And of course, our own elections uncertain next year. Thank you for that analysis. Viv Govender, Senior Analyst at Rand Swiss.